Hello. In part 6, we're going to look at the cash budget. In previous demonstrations, we looked at the sales budget, the production budget, the direct materials purchases budget, the direct labor budget, and in the last one, we looked at manufacturing overhead budget. I skipped the selling and administrative expense budget because it's very similar to the overhead budget. And you can get the information from the assumptions. You've got your variable costs and your fixed costs. And like the production or the overhead budget, we are deducting depreciation to get to our cash payments. Remember, in the cash budget, we only want to look at cash inflows and cash outflows. So to start the cash budget, we look at our cash inflows. And our cash inflows in this budget are going to come from sales revenue. So I've brought down the sales revenue numbers from our sales budget. Other cash receipts that you might get could be from interest, dividends that you've received for investments, possibly sale of assets or investments. For this example, we're just going to be looking at sales. This company sells all their goods on account, meaning that they collect from their customers after the date of sale. So we're going to go over to the assumptions to look at what are our assumptions regarding cash receipts. And our cash receipt assumptions are that in the month of sale, we're going to collect 40%, and the month after sale, we're going to collect 60%. Now, if you go back to the very first part of our budget, we had the balance sheet from the end of the previous period. And couple of things from here are going to flow into our cash budget. One is accounts receivable. We're going to assume that in January we'll collect all of our December 31st accounts receivable. So that will be part of our cash inflow. We're also going to assume that we will pay all of our December 31st accounts payable. So if you look at our cash budget, you'll see that we start with beginning accounts receivable, or beginning of the quarter accounts receivable. So equals, and I'm going to go back to my accounts receivable and pick up that amount. Now, the next thing we need to do is we need to look at how are we going to be collecting our sales. Now, remember our assumption was that 40% in the month of sale and 60% in the month after. So, January sales was $60,000. So, we're going to start with that. And in January times, we expect to collect, we're going to go back over to our assumptions, and we expect to collect 40% in the month of sale. So I'm clicking on the 40%. Remember, every time we go to the assumptions, we want to use F4 to make it an absolute cell reference. So you can see that when we get back over here, we've got the dollar signs around that. Now, in January, those will be our two cash collections. So we'll collect December accounts receivable, and we'll collect January 40% of January sales. So our total cash receipts is just going to be those two. I'm going to use auto sum so that I can copy that across, and I'll automatically, notice I can copy it now, and I'll get the totals as we go. Now, 40% was collected in January. That means the other 60% is going to be collected in February. So we start with our January times, and we go over to our assumptions, and we pick up 60% for the month after sales. So 40% in the month of sales and 60% in the month after sales. Now, normally you would just have prior month, current month, and then you could copy them over. I've set it up like this so you can see what's happening. So when we go across, for the quarter, we will have collected all of our beginning. And then when I total my January sales across, you'll notice that 60,000 equals the total sales for January. And that means that we've collected everything for January. Now in February we collected 60% of January, but we're also going to collect 40% of February. So we start with our February sales times back to our assumptions and up to 40%. Now the 40% has been collected in the month of the sale. Now the 60% or remainder will be collected in March. So we could do 60%, or we can take February sales minus what we collected in February, and the remainder will be collected in March. Now in March, we're only going to collect 40% of the sales for March. So I'm going to go back over to my assumptions and up to my 40% and hit enter. So I have my March sales now. Whoops, I didn't do it right. So equals March times, and go over and pick up my 40%. There we go. So as I copy these down, you'll see I've collected all of February. Here's February sales, 66,000. That's the total. But I haven't collected all of March, have I? What I haven't collected becomes the 12, 31, 10 accounts receivable. So my 1231 accounts receivable is going to be my March sales minus what I've already collected, the 28.8. So when we get to doing our balance sheet, we'll need that 43,200 for our accounts receivable. So in the first part of this demonstration, we've completed the cash budget. I'm sorry, we didn't complete we completed the cash receipts. The next section will be the cash payments. So I'm going to make that a separate demonstration of cash payments. So this demonstration has showed you how to do the cash receipts, and we now have our cash receipts for January, February, March, and the quarter. Remember, this concept, this sort of stepped approach, is what's called a lagged receipt, where some is received in the month of the sale, some in the month after. And it can go out even 2 months after. I hope this demonstration has been helpful.